you go on that note. Of course, we'll talk to you all through the day. So we'll catch you later. But let's go across conversation with and to get a sense of how the Indian markets are doing and what to expect going forward on the fundamental side. Taher Badshah, CIO at Invesco Mutual Fund, joining us. Tahir, wishing you a very good morning. Hi, this is Harsha. Tahir, let me start off by understanding from you as to how you're viewing the Indian markets at the current juncture. There is plenty that's happened on the regulatory side. Have markets run up sufficiently, or is there still scope for a meaningful uptick where the re-rating with regard to growth possibility is concerned?
Well, I think with regard to growth, I think we've seen some improvement as far as this quarter is concerned. Earnings have turned out to be modestly better than expectations, but we also need to remember that this has been, when you look down and dissect the earnings a little more granularly, it has been driven by some of the commodity-related businesses, and that part has actually done well in the recent past. So that has led to overall numbers coming out better than expectations. But in general, I think even if you were to probably strip that out, I think net it has been a little better than the last 2 quarters. So that is in line with market expectations, in the sense that markets were expecting a recovery, especially after the many regulatory measures and the interventions which have been brought about by the government over the last year or so. But perhaps they may not necessarily be sufficient, and we need to probably see if things accelerate further. We also need to remember that some part of the earnings have also been boosted by the recent GST changes, and that we need to therefore see whether this excitement actually holds on post the festive season as well. It's quite likely that we might see some cool off in the subsequent quarter, but then we need to focus on the more longer term trajectory. So over the next 2-3 quarters, I think that is what will be crucial. We need to get to a earnings range somewhere between 12 to 15% on a sustainable basis for Indian markets to show a more meaningful uptick. Up until then, I would like to think that given where we are from the point of view of our global positioning as far as tariffs are concerned, as far as AI is concerned, and so on, and in that context, in that backdrop, it will be difficult for India to probably meaningfully show material upsides or material expansion in multiples. We will have to significantly depend upon growth acceleration, and we will have to ensure that we activate as many of the domestic levers as possible in order to boost our domestic growth and thereby earnings as well.
Right. Tahir, you just speak about earnings. Overall, what is your sense on the second quarter earnings gone by, especially from the larger end of the market, the large caps? Because select sectors have done well. We've seen mixed earnings, but overall the sentiment is that it's been better than what the street was estimating. Do you concur with that? And where do you think we're headed in terms of earnings for the second half?
So like I said, I mean, to your question on the large caps, I think the earnings delivery, particularly in sectors like banking and financial services, as well as in case of tech, being some of the more prominent large cap names out there, has been reasonably decent, I would say. I mean, maybe the numbers are not as striking, but the good part is that the commentaries are good, particularly as far as tech is concerned. And I think that is a sector which can see some alleviation if at all, policy changes were to happen at a global scale, and we see some rollback on tariffs, etc. Some of the export sectors, particularly tech, may be sentimentally better. And in any case, I think there is a reason to believe that as we go into later part of FY27, hopefully the tech sector, even in terms of growth, may probably accelerate. So that part of the large cap space has done well. And then meanwhile, we've also had a few commodity parts, which, like I called out, have done well on the large caps, particularly the metal-oriented companies. And I think we've seen reasonable improvement in some of the large cap consumer discretionary names as well. So in all, I would say that the large cap basket has done quite well. Going forward, as I said, what we need to watch is sustainability of the growth, particularly in the overall consumption space, which has been quite strong thanks to GST and a few other factors. We need to, if we can get that part to remain reasonably strong even over the subsequent quarters, perhaps not maybe in the December quarter, because there will be a cool off post festive season. But beginning Jan 2026, if the first two quarters pan out well, then it'll basically, I think, give a lot of confidence to the market that some of these levers that we've activated in the last some time, whether it be with regard to public spending, whether it be with regard to GST, interest rates, and so on, are starting to percolate down in the system. Even the effect of the good monsoons that we have seen should hopefully support that. So I think the evidence of that will come about in the first quarter, and that is when we feel that if things sustain, then that may probably become the trigger for the market to scale newer highs. But up until then, we might be a little range bound on the indices, but we might see relatively more action, continue to see action as far as the broader markets is concerned.
And Tahir, what keeps you upbeat with regard to tech? Give us a sense, because there's just so much happening. There's so many risks with regard to IT cores, especially given AI. You throw in deglobalization as one of the other concerns. What keeps you positive?
So, you're right, and we don't have answers. I mean, the sector doesn't have answers to all these things at this stage, Harsh. But we also know that some part of it is kind of baked into the valuations, because we've seen continuous, headwinds coming out of growth, coming out of AI, coming out of, things like the regulatory changes, especially what the US is considering with regard to visas and so on. So, in a way, the way we are looking at tech currently is that there are pockets of tech which are reasonably attractive from a valuation standpoint to begin with. I mean, not necessarily in terms of P multiples, but perhaps if you look at them in terms of free cash flow yields, they are at reasonably attractive levels. So we take comfort in the fact that downside perhaps is relatively better protected. How the upside manifests is something that we have to watch out for, and so we ensure at least that we have that necessary safety net in terms of downside, and then we would like to think that some of the negativities which have surrounded the sector will hopefully ease as we go along, and then as we get into FY28, perhaps by which time we would expect even some of the AI related growth challenges to somewhat subside. I'm not exactly saying that AI will go away. That is something which is going to remain in my view. But alongside that, still we might probably see discretionary spending in the US come back. And if that were to happen and we see some uptick in growth, then there will be valuation upside as well. So this is how we are playing it, within which we have to obviously focus on some of the better performing machines compared to some of the other laggards.
Okay, and Tahir, now that the GST cut play is underway and we're seeing positive commentary from most of the consumption companies, do you believe it's going to be value consumption or discretionary consumption that could be the next growth lever for the overall consumption back?
So I think at least for the last some time, we have been focused on the value side of consumption from an incremental standpoint. The last 2-3 years have belonged to, more of the upper end of the K and upper end of the income spectrum, largely defined by premium products and premiumization trends. I think that is starting to see some shift, and expect that to continue on the back of everything from lower inflation, lower interest rates, rising rural incomes, and we are seeing that in quite a number of businesses are calling out the fact that urban growth has been somewhat slower and rural growth, on the other hand, has been accelerating. So I think that will probably remain a play for the subsequent for the upcoming future as far as consumption is concerned.
And Tahir, you also hinted that large caps is the tilt you're playing. Are you holding any cash at this point, or because we know you to be a value investor, trying to understand whether how valuations are stacking up for you at this point? How are you viewing it? Are you holding any cash? And what was the scenario maybe 3 months ago? Were you holding cash then? Have you deployed some of it? Give us a sense.
So to correct you, basically what I'm saying is that, to your question on earnings recovery as far as earnings performance of some of the large cap companies, they have done well in my view, especially relative to expectations. But in general, we still see decent amount of pockets of growth in the broader parts of the economy. And there we could also probably see certain stocks in the large cap space which are doing well. But by and large, the mid cap and small cap canvas is still pretty exciting. There are a good number of emerging growth pockets which are growing well ahead of system rate of growth, and we continue to focus on that quite meaningfully. And I think at this level, as even as large caps continue to give us that backbone to some extent in certain pockets, but for us, alpha generation ability will have to come out of bottom up identification of ideas in the more broader mid and small cap market space. And your question of cash, we generally don't take cash calls under most market circumstances. Even in the height of COVID, if I recollect, we were probably fully invested. So we typically, as a housekeeping, um, uh, rationale, I mean, we ensure that we generally do not have more than 5% cash in our portfolios. It will be, on an average, on most times that you speak to me, it will probably be more in the vicinity of 2 to 3%, if at all. So I think we prefer to be fully invested and try and identify good ideas and try to put investors' money to work.
Okay, Tahir, appreciate that view and appreciate you joining us this morning as well. Thank you so much for your time.